I'm Mark Roach, and this is FutureWise Energy. Let's talk about what's actually happening in upstream oil and gas markets right now. WTI crude is sitting at $62.60 per barrel, up about 0.6% this week, while natural gas hit $3.10 per million BTU. That's a 48% jump year over year. Now, Baker Hughes' rig count shows that we're up 2 rigs to a total of 539, but we're still down 51 rigs compared to this time last year. Oil-directed rigs climbed by 2 to 416, gas-directed rigs held at 118. The regional activity is telling Eagle Ford added 3 rigs. Cana Woodford and Utica each picked up 1. Those aren't desperate moves. Operators are being surgical about where they deploy capital. The days of throwing rigs at every decent rock are over. M&A activity dropped 60% in the first half of 2025 compared to last year, even after the 2024 hit of $105 billion in upstream deals, the third highest annual total on record. But look at what's actually getting done. Chord Energy just paid $550 million for 48,000 net acres in the Williston Basin from ExxonMobil's XTO. That acreage produces about 9,000 barrels of oil equivalent per day with the existing infrastructure and proven reserves. This is what smart money looks like. I mean, it's buying cash flow, not potential. Private equity has fundamentally shifted its approach. Instead of funding drilling campaigns, they're focusing on operational improvements and efficiency gains. The easy money from checkbook geology is gone. Now it's about extracting value from what you already have. Meanwhile, offshore discoveries continue to rewrite the conventional wisdom. BP just announced their Boomerang field in Brazil, Santos Basin, their largest discovery in 25 years with 500-meter hydrocarbon column. Offshore Namibia keeps delivering multi-billion barrel discoveries through Shell, Total Energies, and Gulp. These aren't wildcats, they're systemic campaigns targeting proven geologic concepts. Technology development is where the real action is. Lateral lengths routinely exceed 10,000 feet now, with some reaching 15,000 feet. Completion designs have moved beyond simple stage counts to optimize sand placement and enhance reservoir contact. Digital and AI applications are driving measurable efficiency improvements across drilling, completion, and production operations. The EIA forecasts WTI averaging $64.16 per barrel for 2025, dropping to $47.77 in 2026. Natural gas shows more strength, with Henry Hub projected above $4 per MMBTU in 2026, supported by record LNG exports. U.S. oil production is expected to peak near 13.6 million barrels per day in late 2025 before moderating. What we're seeing is an industry that has fundamentally changed how it operates. The upstream sector has moved from growth at any cost to returns-focused precision. Companies are targeting high-efficiency plays, optimizing completion designs, and pursuing selective acquisitions of premium acreage. The consolidation trend will continue, particularly in premier basins where scale creates competitive advantages. Small and mid-cap E&P companies face a choice: find creative partnerships or prepare for strategic alternatives. The market rewards operators who understand the difference between activity and productivity, between drilling wells and creating value. The survivors won't be those who drill the most, they'll be the ones who drill the right wells at the right time in the right places with the right economics. That's where we stand in today's upstream market. The fundamentals have shifted, the business models evolved, and the winners are those who will adapt first. I'm Mark Roach. This is FutureWise Energy.